Now we will start with another chapter called Basel II Accord and Overview. So let us try to understand what is the meaning of Basel II Accord. For this we will divide the topic into the following subtopics. One is called Introduction, second is Basel II Recommendations on Capital Charge. What are the recommendations of the Basel II Committee? Then Minimum Capital Requirement for the banks. Then Supervisory Review Process. What is the process laid down there? What is called market discipline and different types of risks faced by the banking industry. Then a little about the features of the Indian financial system. So this we will consider. Let us start with the introduction. As we all know, this Basel supervision started way back in 1975. In 1975, a standing committee of bank supervisors called Committee on Banking Regulation and Supervising Practices was set up under the auspices of the Bank for the International Settlements, Basel. So that bank is based at Basel, that is Switzerland. Therefore, it is known as the Basel Accord. What was the objective? The objective was to ensure that all banks are supervised according to certain broad principles. They wanted to have some kind of uniformity on the supervision of different banks operating in different countries, so that when they interact with each other, when there are transactions between two banks, it becomes easier for them to deal with the banks if they follow certain standard practices in terms of supervision. So the Basel Capital Accord Agreement was signed in July 1988. So that was called Basel I. Basel I was originally designed to apply to only internationally active banks in the G10 countries. It was later accepted by several countries. To start with, it was only meant for those banks which were exposed to international transactions, and that too particularly in the G10 countries, which has now been accepted by most of the countries. And then they wanted to revise this Basel I based on the experience gained, and therefore Basel II was adopted on 26 June 2004. It came into effect by the end of 2006. So for the last 5 years, Basel II has been in operation in India also. The new standards are mandatory for internationally active banks. So in the case of banks which have got international exposure or international transactions, it is mandatory, whereas in the case of other banks which are only dealing in the domestic market, also to have these norms complied with. So let us try to understand what are the basic recommendations of the Basel II Accord on capital charge. So the objective of Basel II recommendations are as under. One is promotion of safety and soundness in the financial system. The basic objective is there should be safety. That means when you deal with a bank internationally, you should know that that bank is safe to deal with. So this kind of safety thing has to be brought in by introducing certain principles which are mandatory in nature, particularly in the form of capital requirements. Therefore, this is one of the important objectives. The enhancement of competitive equality and the constitution of a more comprehensive approach to address risk. As we know, banks are faced with a lot of risk, and unless these risks are addressed systematically, banks will end up in trouble. So in order to ensure that banks address these risks, certain guidelines have been laid down and they have been made mandatory. So therefore Basel II came out with 3 mutually reinforcing pillars. This is the most important change in the Basel II recommendations. They recognize 3 pillars, and for each of these pillars they came out with different recommendations to be followed by banks all over the world. One is called risk based capital, that is called the pillar 1, that is assessment of minimum capital requirement of banks. So what it says is that all banks need to have minimum capital requirements, and how to calculate this capital requirement in relation to the assets they have or in relation to the liabilities they have, that is detailed in pillar 1. And pillar 2 is in respect of risk based supervision. That means this is mainly for the supervisory authorities to supervise the banking industry in that particular country. In the case of India, of course, RBI is the regulator of the banking industry. So supervision is mainly applicable to such central banks of the country which are supervising the banks. So, this is supervision to review banks, capital adequacy and internal assessment process. So, the basic objective here is each banking industry supervisor has to review all the banks in that particular country and try to find out as to what is the capital adequacy requirement and what is the internal assessment process in assessing the various risks faced by the banks in that particular country. And third is what we call market discipline, that is the most important pillar. That is, market discipline, it says, can be brought about by following greater transparency and disclosure norms. That means, if you disclose more or if you are made to disclose more, then that will automatically ensure that the banks will fall in line and try to follow market discipline, because disclosure will bring certain kind of responsibility and make the banks follow best international practices. That is the objective of pillar number 3, that is called market discipline. So, now let us start with each of the 3 pillars. The first pillar, as I said, is relating to capital charge, that is what is the capital requirement. So, in the case of Basel II, it says minimum capital requirement of 8% of risk assets. That means each bank should have capital of 8% of the total risk assets. It is not merely assets, they have to be classified in terms of risk asset. That means each asset has a different kind of risk, and based on that it has to be weighted. So, what it says is capital adequacy ratio has to be computed by the formula given as under. One is total capital divided by risk weighted assets into 100. That means even if the assets may be 100, the total risk weighted assets can be more than 100 or less than 100, depending on the weightage given to different types of assets. If the assets are more risky, naturally more weightage will be given. That means if you want to hold those assets, we need to bring in more capital. If the assets are less risky, then less weightage is given. That means in order to hold those assets, you need not have more capital. For example, let us take a simple example. You have an asset of 100 rupees invested in government securities in the bank. Government securities totally risk free in the case of India, because there is no question of default by the government. So, that is given a weightage of 0. That means in order to invest money or create asset in the form of government securities, bank need not have any capital at all. Whereas if they lend to, let us say, in the stock market, there is more risk. So, if you want to create those assets, let us say the weightage is 120%. It is only an example to illustrate. So, if they want to create an asset of 100 rupees, the risk weighted asset will be 120. So, you have to provide capital at the rate of 8% on 120 and not on 100. That means instead of 8 rupees as capital, we need to have 9.6 rupees as capital. That means your capital requirement will go up depending on the riskiness of the assets. The higher the risk of the assets, higher is the capital required. So, that is the most important change which has been brought about by introducing the concept of risk weighted assets. And in the case of this, they also go into the details of as to what should be the numerator and the denominator. As you have seen, in the numerator you have total capital and in the denominator you have risk weighted assets. So, they will decide what should be total capital. So, they say again that the total capital can be of 3 types of capital. One is called tier 1 capital, other is called tier 2 capital, third one is called tier 3 capital. So, tier 1 capital is the most important capital. It belongs to the shareholders equity plus retained earnings. That means whatever profits the entity is making, if they are retained in the company, it is treated as part of the tier 1 capital. Tier 2 capital is consisting of supplementary capital, also known as subordinated debt. That means it is capital which has to be repaid, but after a certain length of time, normally more than 10 years. And the tier 3 capital is some short term subordinated debt, which has now not been introduced in India so far. So, in India we have only tier 1 capital and tier 2 capital. Tier 3 capital will come to India at a later stage. And in the case of denominator, that is risk weighted assets, again we have 3 types of risks. So, all these risks have to be given weightage. One is called the credit risk, second is called the operational risk, third is called the market risk. So, we will be studying these details separately and another subject, but for the present it is suffice to know that the capital adequacy ratio has to be calculated on the basis of total capital divided by the risk weighted assets. And the second pillar of the Basel II Accord is called what is known as the supervisory review process. So, what it says is the supervisors of the banking industry must review the processes put in place by different banks, and for that the supervisor should have a system of ensuring that banks have a process for assessing their overall capital adequacy in relation to the risk profile and a strategy for monitoring their capital levels. That means each bank should assess their overall capital adequacy, whether capital is adequate or not to take on fresh business. That means they should not go below that minimum capital adequacy as detailed in the Basel II Accord. And secondly, they should keep on monitoring this level at all points of time. If business keeps going up, which means they will be creating more assets, which means they will have to bring in more capital. So, on a periodical basis, constantly the banks will have to find out what is their level of capital adequacy and try to ensure that they do not fall below the minimum laid down in the Basel II Accord. In addition to that, the supervisor, that is the Reserve Bank of India in the case of India, should review and evaluate banks' internal capital adequacy assessment and strategies, as well as their ability to monitor and ensure their compliance with regulatory capital ratios. This is the most important part of the supervisory review process. That means it should not be left only to the banks. Even the Reserve Bank of India should have a system of trying to evaluate what each bank is doing, whether they have a proper process, whether they are able to adequately assess their capital adequacy requirements, whether they have a policy to monitor the capital adequacy levels, and whether they are complying with the regulatory minimum capital ratios, whether they are maintaining that 8% minimum at all points of time. So, this becomes incumbent upon the Reserve Bank of India to ensure that each bank does have a proper system. Similarly, the Reserve Bank of India, that is the supervisory authority, should have powers to expect banks to operate above the minimum regulatory capital ratios and should have the ability to require banks to hold capital in excess of the minimum. So, these words are very important here. Should expect banks to operate above the minimum regulatory capital ratios and should have the ability to require banks to hold capital. What does it mean is that there should be enough powers given to the supervisor, that is Reserve Bank of India in the case of India, to ensure that banks do fall in line. That means the supervisor should have the necessary authority to punish those banks which do not fall in line. That means lot of statutory powers need to be given to the supervisor. That is the meaning of this. And further, it also goes on to say that the supervisor should seek to intervene at an early stage to prevent capital from falling below the minimum level and should require rapid remedial action if capital is not maintained or restored. In addition to that, in case of those banks which are not able to maintain minimum capital ratios, then the supervisor should have the powers to take appropriate action even before the capital falls below that level. Suppose they find that a particular bank is nearing that threshold limit and it is likely to fall in the future, then the supervisor should start the process immediately even before the capital falls below that level. That means they should have wide ranging powers to take action against those banks so that all banks in a particular country are able to maintain those minimum capital requirements. Then we come to the third pillar of the Basel II Accord, that is called the market discipline. Here basically the logic is very simple. Market discipline means the market itself will force the banks to fall in line, and that happens only if the banks are able to disclose everything to the public. Once they are forced to disclose things, then they will ensure that they follow all the norms. So, the disclosure norms have to be made more strict and more strong. So, what this says is market discipline imposes strong incentives to banks to conduct their business in a safe, sound and effective manner. So, this can be done only through what is known as a series of disclosure requirements on the capital, risk exposure, etc., so that market participant can assess banks' capital adequacy. Once you force banks to disclose what is their capital, what is their risk exposure, how do they assess, all these factors if they are disclosed periodically, then outsiders can assess the risk of the bank, also can assess the capital adequacy of that bank, and based on that they can take decisions, and that will force the banks to fall in line. That is the meaning of market discipline. And what kind of disclosure they say? They say the disclosure should be made at least semi-annually and more frequently if appropriate. That means disclosure should not be only at the end of a particular year, they should be at least at half yearly intervals and more if it is necessary. In the case of India, as you know, most of the companies are made to disclose at least quarterly. That means they have to come out with their profit and loss and balance sheets at every quarter, and along with that profit and loss and balance sheet they are required to disclose lot of other things. So, disclosures have to be more frequent, but at least at half yearly intervals. Now, let us try to understand the different types of risks faced by banks, not only in India but throughout the world. Normally, we talk of credit risk, because credit risk is the most important risk faced by the bank, because the most important activity of the bank is to lend money. So, whenever there is lending of money, there is a credit risk, because the risk of default by the borrowers, that is called the credit risk. So, this credit risk also has to be measured, and then they have to take the steps. So, Basel II proposes three principal options. One is called the standard approach, the other is called the internal rating based approach, third is called the securitization framework. And we will not be going into the details of these different measures. This is being taken up in a separate paper. That time we will be studying in detail about the different methods which are used for assessing credit risk. Similarly, in the case of operational risk, Basel II Accord gives three approaches for measurement of operational risk. One is called the basic indicator approach, second is called the standard approach, third is called the advanced measurement approach. And how these approaches are used for measurement will be done in a separate chapter, in a separate paper. Coming to market risk, we have again market risk can be calculated based on specific risk or general market risk. And capital charge for specific risk, so again what they say is, in addition to capital charge for risk weighted assets, for certain risks also capital has to be provided. So what it says is, capital charge for specific risk is designed to protect against an adverse movement in price of an individual security due to factors related to the individual issuer. The specific risk charges are divided into various categories such as investments in government securities, claims on banks, investments in mortgage backed securities, securitized papers, etc. Capital charge for each category is fixed. So it lays down different ways of calculating different capital charges for different kinds of risk. And capital charge for general market risk also is proposed. It says that it is designed to capture the risk of loss arising from changes in market interest rates. Because of changes in the interest rates in the market, you have lot of risk in respect of those investments which are subject to interest rate risk. So there we need to provide for additional capital. So that also has been proposed in Basel II Accord. Now lastly, we will come to something about the Indian financial system. What are the different features of that? There we have got regulatory initiatives. As you know, Reserve Bank of India is the regulator of the banking industry in India. So they have taken several initiatives for regulation of the banking industry. So there it says that each bank should have a suitable risk management framework. According to RBI, each bank must have a management framework to assess risk. So this is called a risk management framework. Normally this is headed by a top management official, so that the risk is assessed properly and taken care of. Then introduction of risk based supervision. So supervision should be based on the risk. And third is banks to formalize the capital adequacy assessment program in alignment with the business plan and performance budgetary system. That means whenever banks try to introduce a budgetary system or undertaking new business, fresh business, they should also take into account what is the capital required for increasing this kind of business. That means whether capital is adequate to take on the new business. This also has to be taken into account by the bank. Finally, enhancement in the areas of disclosure so as to have greater transparency of the financial position and risk profile of banks. So banks should try to come out with more and more disclosures so that everything is disclosed to the public, and this will by itself introduce what is known as market discipline. And finally, they say improvement in the level of corporate governance standards in banks. Corporate governance is one area which is being given a lot of importance, wherein banks are mandatorily required to disclose lot of things which they will be following in course of time to improve the corporate governance in the banks. Now let us try to understand something about the provisioning for NPA and risk-weighted assets as given in Basel II. As you know, NPA is nothing but non-performing asset. That means whenever an asset becomes non-performing, we need to provide for that. That means there will not be any income generated on account of the non-performing assets. In addition to that, banks will have to keep certain money separately in the form of provisions to take care of those non-performing assets. And in the case of that, there have been some changes in regard to Basel 1 and 2. So, we will see what are the changes in the case of Basel 1 and 2. In the case of Basel 1, provisions for fund based exposures, and in the proposed measures for Basel 2 is banks should make provisions for the non-fund based assessments in the NPA account. That means there was only provision for fund based exposures. For non-fund based there was no provision. So, in the case of Basel 2, you have to start providing funds for non-fund based exposures also. For example, your letters of credit and guarantees where no funds are involved, but still if they turn out NPAs, we need to provide for. That means a certain portion of the profit has to be kept separately to take care of these non-fund based commitments. Then in the present case, asset classification is based on the record of recovery in each bank, with the result that a borrower may be a performing asset with a particular bank and a non-performing asset with another bank. That means if there is a borrower who has borrowed from two banks, in one bank he is regular and another bank is not regular. So, one bank will classify that borrower as a performing asset, with another bank it is classified as a non-performing asset, which is actually ridiculous. So, we have gone to the uniform asset classification across the banking system in the case of the Basel II provision. That means if a borrower is classified as NPA with one bank, will automatically be classified as NPA with another bank. So, you cannot have the same borrower being classified as NPA with one bank and a standard asset with another bank. And in the case of provisioning requirements, again there have been changes. Presently, as you see on the blackboard, the substandard secured assets at 10%, substandard unsecured 20%, doubtful 15 months to 27 months is 20%, 27 months to 51 months is 20%, and over 51 months 100%, and capital adequacy is 8%. Whereas the present position is as under, it is 20% for substandard secured and 30% for substandard unsecured. That means they have increased it by 10% each. And in the case of doubtful assets, it is again there is a demarcation between secured and unsecured. In the case of 15 months to 27 months for doubtful, they have made it 20% for secured and 30% for unsecured. Similarly, for 27 months to 51 months, they have made it 20% for secured and 100% for unsecured. So, there has been a significant jump in the case of provision if the doubtful NPA is unsecured. Similarly, in the case of doubtful over 51%, it is 30% for secured, which earlier was 20%, and for unsecured it is again 100%. And capital adequacy earlier was 8%, now it has been increased to 9%. So, in the beginning I said no, that Basel II Accord says minimum capital requirement is 8%, but Reserve Bank of India in India has made capital adequacy at 9%. That means we have gone one step ahead of the Basel II and prescribed a higher capital adequacy ratio in the case of all banks working in India. And similarly, there is a higher core capital ratio from 50% to 66%. That means tier 1 capital has to be not just 50%, but 66% of the total capital. With this, we come to the end of this section, and in the next section we will be talking about bond valuations.